Hello there, I'm Professor Indra Abeysekera. One of the learning goals in this workshop is for us to understand two measurement models for tangible assets. Cost model and revaluation model are the two measurement models. Whether you choose the cost model or the revaluation model, that model must be applied to a given class of asset. That the groupings of assets must apply to a given class. So you can apply cost model for motor vehicle class, for example, and then I can apply the revaluation model for land class in the same company, same organization. So in both models, we take the cost of acquisition and then deduct accumulated depreciation and accumulated impairment losses. Under the cost model, you take the cost of acquisition. That doesn't change. But under the revaluation model, the cost, initially recorded cost, can get revised up or down. That is called the revalued cost. So in that model, you take the revalued cost and take away accumulated depreciation and take away accumulated impairment losses to come up with the carrying value of the asset at a given time. So you can see there that the impairment losses applies to both models. Depreciation also applies to both models. Let's look at each model separately. Revaluation model. For us to revise the value of the asset, we must compare the carrying amount of the asset. It is the cost minus accumulated depreciation and impairment losses. That's the carrying value, not just the cost. Carrying amount with the fair value. Fair value is the value that will be provided by a third party at arm's length. We can take market value as a proxy. So let's take market value as a proxy, say 150 market value, but the carrying value is 100. Under the revaluation model, we can increase this value, carrying amount, to match with the market value, 150, and then we can write a journal entry. And that increase from 100 to 150, that increase of 50 is called the revaluation surplus. Due to revaluation, the surplus that company has received, called the revaluation surplus. Similarly, market value could be less than the carrying amount. Here, market value or the fair value is 80 and carrying amount is 100. And now we need to decrease the carrying amount to match with the market value or the fair value. And that decrease is called loss on revaluation. It's the opposite. Loss on revaluation. So under the revaluation model, carrying value could be revised upwards or downwards. So here are the steps for us to write journal entries. Before we revise the asset value, we must reverse the accumulated depreciation into the asset cost account. So we debit accumulated depreciation and credit asset. So the asset cost account will have the cost, original cost, minus accumulated depreciation. Once that is done, step 2, we can increase the carrying value of the asset, because that is the carrying value of the asset. Cost less accumulated depreciation. We can increase to the market value or the fair value. So we debit asset for that increase and credit revaluation surplus for that increase. Under the cost model, if the carrying amount, if the market value is greater than the carrying amount, we do nothing, because we can't increase the carrying amount. It will always go down and down, but not up under the cost model, because we take the cost of acquisition of the asset and then we deduct accumulated depreciation and impairment losses. We come up with the carrying amount and we go on with that. When there's a decrease, let's say our carrying amount after depreciation or that is 100, but the fair value or the market value is 80, then we must decrease to match with the market value. So that decrease is called impairment. That is called impairment. So under the cost model, we can match with the market downwards only. Under the revaluation model, we can match with the market upwards and downwards, both ways. Downward is called, under the revaluation model, is not called impairment, loss in revaluation, and upwards is called revaluation surplus. Let me show you 3 scenarios under the revaluation model. Now I am going back to revaluation model. Let's say there's a revaluation increase and there was no previous downward revaluation. So step 1, we reverse accumulated depreciation, then we increase the asset value. Let's take revaluation increase and there was a previous downward revaluation and there was a downward revaluation of 5, and that downward revaluation, when there is no revaluation surplus, that will be shown in the income statement as a loss in revaluation. So the first step for revaluation, we reverse the accumulated depreciation into the cost account, and then we look at the asset here. Asset has increased in value of 10, but there was a downward previous revaluation. We can now make use of that. We can reverse that. So we credit income to reverse that previous downward revaluation in a previous year. We do that in the current year as income here. And the remaining amount we will credit to revaluation surplus. Third scenario, there's a revaluation decrease and there was previous downward revaluation. If there was previous downward revaluation, it was a loss. Our first step, whether we revise the value upward or downwards, first step is reverse accumulated depreciation. Here it is, into the asset account. Now there's a downward revaluation, so we recognize that loss in the income statement, loss in revaluation surplus, and we credit the asset to decrease the asset value by 5, because the carrying amount was 80 and the revaluation value is 5, so the decrease is 5.